Welcome to Just Build Wealth. I'm Ryan Ross.
And I'm Mike Ross. In Just Build Wealth, we challenge the traditional views of financial advice and investing.
So we're going to dig in deep into the advisory world, speaking with professional investors, advisors, private equity managers, RIAs, even the occasional art appraiser, forensic accountant, philanthropist, or a geopolitical strategist. One traditional view is about investing abroad.
We believe that you can get great returns by investing exclusively in U.S.-based stocks, thus avoiding the risks of international investing. We will discuss this with guests throughout the show.
Another traditional view is that investing ideas are only found in white papers.
In my experience, investing ideas do not just come from financial literature. So we will expand our scope and talk to a wide range of business minds and industry thought leaders. All eyes will be toward challenging traditional ideas. At the end of the day, we want to help you, the advisor or professional investor, learn how to invest more intelligently, build better relationships, and retain more clients. We believe that financial advice and portfolio management should go hand in hand. They are two sides of the same coin, or, to quote Forrest Gump, they go together like peas and carrots.
All of this and much more is also noted and discussed in your new book, which is titled
The False Hope of Global Diversification, Confessions of a Portfolio Management Maverick.
For this episode of Just Build Wealth, we speak with Adam Coffey, a veteran private equity roll-up master, author of the Private Equity Playbook and the Exit Strategy Playbook. In this episode, we talk about the size of the private equity market, why industrial fragmentation works in favor of business buyers, and how to find that fragmentation. We talk about why multiples go up the bigger a company is. We talk about the team structure when setting up a strategic acquisitions department. Adam was involved in the business of making things cold, so we talk about why cell phone towers actually need refrigeration. And if you're a business owner that is thinking about selling your business, we discuss which specific time of year is ideal to consider an exit. There are seasons to consider an exit in, and we talk about the right one. And then we talk about steps to take if you are thinking about an exit in general. So enjoy this conversation with Adam Coffey. Adam Coffey, hi, welcome to Just Build Wealth today. We are really excited to have you here. We read your books, the Private Equity Playbook and the Exit Strategy Playbook. So we're really excited to just explore these ideas about the things you've written. Could you just give us a little bit of background about who you are and what you've been doing?
Sure. Hey, absolutely. Thanks for having me on. Hello to all your listeners out there. 4 things about me. Veteran U.S. Army. Hoo-ah! Military taught me something about discipline, teamwork, leadership. Engineering background made me an anal retentive strategic planner. I spent 10 years at GE during the Jack Welch era, the Camelot era of GE. Stock split 3 times. Money just fell from the sky when I was a young buck. And I tell people GE taught me how to run a business. And then 4th, 21 years experience as a CEO, 3 different companies, 9 different private equity sponsors, 58 acquisitions, career batting average, 5 times multiple of invested capital. That's kind of me in a nutshell.
Okay, I think you left out one important thing that I found on your website.
A couple books and yeah.
That too. But I'm very curious. I was digging through your website and I saw this thing called the Burger Chaser. What is the Burger Chaser?
Well, I'm a pilot, and when you're a pilot, you're famously known for chasing $150 hamburgers. Although in today's world, it's probably $300 hamburgers. So it's guys who like to get up in the air and just go fly someplace and have a meal, usually when you get there. And so I call my airplane the Fair Weather Burger Chaser.
Okay. That's hilarious. I didn't know where that was going to go, but the analogy is really funny. You're like, are you saying, where can I find the most expensive hamburger?
Well, because the cost of the fuel for the aircraft, it's like it's jokingly known by pilots as, the $150 hamburger. It's probably more like a $300 hamburger in today's world. Yeah. But when you're going up with pilot buddies, the first thing you're doing is you're planning, where am I going to eat? And so, airports buy the restaurants they have at them. And Yeah, that's another podcast. I can clue you in where there's a bunch of great, off the beaten track airport restaurants out there in the world.
So this show is about challenging traditional views or assumptions in investing. And one assumption that I have, what I'm referring to the private equity book, is talking about when I think private equity, I think like KKR and Carlyle, like just massive companies, and they're doing leveraged buyouts and things like that, and they have huge exits. And I feel like, is it not always a huge private company that private equity would be dealing with?
Well, it's interesting, because certainly you've mentioned some of the top 10 funds on the planet. But if you go back to when I started as a CEO 21 years ago, there were hundreds of PE firms and capital assets under management was measured in the hundreds of billions. Today, there's more than 6,000 PE firms and there's over $5 trillion in assets under management. And so of these 6,000 firms, you have people who specialize literally, I call them swimming lanes, kind of 0 to 15 million of EBITDA is one swimming lane. 15 to 50 is another, 50 to 100, 100 to 200, 200, to public company. And so it's a pyramid of capital. And there's a ton of people who are out there playing with small companies. So it's not just the big guys, the household names, thousands of firms out there, literally. You can't go through a day today, by the way, in today's world, you cannot get through the day without seeing a logo or touching a business in your path that's owned by private equity. Just can't be done.
So you've had a few exits, and if you're looking, if a business owner, right, if they're looking for new ideas, I think if they're what you would call a strategic buyer, if they're looking for new ideas, how do you decide? Maybe they've sold their business and they're looking to get into something new. How do you decide what industry to go in? You personally, maybe.
So from my perspective, I talk a lot about the art of rollover investing and the why sell your company once when you can sell it 2 times or 3 times. My personal record selling the same business 5 times in 13 years and 4 months. So, entrepreneur, you just highlighted a great problem. So entrepreneur builds a company, sells it, cashes out all their chips, walks off into the sunset, has a non-compete for 5 years, and now they think, okay, well, now what the heck do I do? And I tell people, hey, stay in your wheelhouse. You were building a business, why leave? Become a rollover investor, and just take some diversification of your assets in the sale. I actually even coined a law to know when it's time to sell. It's the law of 130. If you take your age and you add to it your percent of net worth that is tied up in your business, if it equals more than 130, then it's probably time to think about diversification of your assets. And so that trying to help entrepreneurs decide when's the right time. And so from my perspective, it's why leave, stay with the business, and then become a rollover investor. You're just no longer the sole shareholder or the majority shareholder, but it doesn't mean you have to start a new adventure someplace else. But to answer your specific question, when I think of people looking to buy businesses, I think typically of search funds, and I think of younger entrepreneurs who are in business school. They're coming out. There's always search funds attached to universities in those towns. And it's like, and then they're off on an adventure looking for some small business to buy, with some type of backing. Ultimately, it then turns into something that gets sold to most likely lower middle market private equity firm. But literally every industry you can think of on the planet has private equity activity in it, today.
So the rollover business, and I believe it's probably the financial buyer who is more enthusiastic about the rollover business, and the strategic buyer wants to turn off the lights, so, as it were. Do I have that right first?
So I put strategic buyers into 2 categories: those who want you to turn off the lights, and I call them strategic buyers who turn off the lights, and then strategic buyers who want you to join the team. And so what's the difference? Well, let me give you some examples from my life. So I was the CEO of a large commercial laundry company, 70,000 laundromats across North America in multiple countries. And in that particular case, the revenue streams, which essentially are leases on buildings, were long term. And when it was long term, the entrepreneurs and the relationships that they've built become less important. In that particular industry, we had a scalable platform. Everybody kind of conducted business the same way. And so we were a strategic backed by private equity who was essentially turning the lights off on the business. But there's an entire another category. When I was the CEO at CoolSys, because of the way the industry contracts, which is any industrial service company contract, can be canceled with 30 days written notice by either party. Doesn't matter if it's a 3-year contract, 5-year contract. So when the nature of contracting is shorter term, and or the relationships built by the entrepreneurs are more important, then in those types of industries, typically strategics do not seek you to exit the business. They want you to stay. They want you to become a rollover investor. They may or may not be backed by private equity. And so really, from my perspective, financial buyers want you to stay, probably want you to be the platform, of an investment. And then in strategic, 2 categories: one that says right off into the sunset, one that says roll over, invest, join the team, and stick around. And let's align ourselves by making us all shareholders in the parent company, with your rollover investment. So those are really the 2 kinds of strategics that I encounter. And I've run as a strategic doing my 58 acquisitions. I have bought companies in both styles, where I'm turning the lights off or asking people to join the team.
So really, as the business seller, you need to have an idea of what you want to do next. If you want to stay in the business, then that's a different series of potential buyers than if you want to ride off into the sunset. Correct?
Yeah, I talk a lot about that in the first section of the Exit Strategy Playbook. I think that's probably often the most egregious mistake entrepreneurs are making. They just wake up one day and say, hey, let's sell my business today, and they haven't really put any forethought into what is the goal and objective here. What are we trying to accomplish? Maybe you're 70 years old. Maybe you want to ride off into the sunset, and so you're seeking a buyer who is going to let you walk out the back door. Financial buyer wants you to stay, not a deal killer if you want to go, but they really want you to stay and be a rollover investor and have skin in the game. And more importantly, they want you to amp up your involvement and be hyperactive for the next 5-year hold period. That they're going to be in there and help them sell the business again when it's time for them to go. And if you contrast that with, again, the strategic that wants you to turn off the lights, you have to put a lot of time and effort in. And I try to help people with kind of a roadmap. It's like, what's your goal and objective? What are you trying to seek? And I go through all the different categories and classes of potential buyers. And some of them include private equity backed adventures and some don't. But, most importantly, I think the entrepreneur really needs to be prepared before they become a seller, and they need to think through, in order to know and understand of the universe of buyers, who should they be more interested and tuned into, rather than just taking every phone call or taking, every meeting, or before they hire the investment banker, trying to decide, what's the right path. Because in order to get to the right destination, you kind of have to have a roadmap of where you're going. And a lot of people kind of forget that step, and they just think of it in terms of who's the high bidder. And that's all I care about. Right. But they might be doing something that's not actually a part of their own strategic thinking about their future. And they can lead themselves down a path of trouble if they haven't kind of mapped that out ahead of time.
So I own 6 or 7 different private equity funds myself, and I know, just based upon the book, you are a private equity investor as well as an operator. I remember I want to say 15 years ago, sitting in a dinner at Stanford University, talking to a couple of professors, and they were emphatic back then that on the investor side, you want to go to the top 5 firms because they get more deal flow than anybody else. And as a consequence, they'll be able to cherry pick, quote unquote, the best deals. From everything you've said, both in the book and just now, that may not be the same approach now in terms of looking for private equity investments as the investor. So what's your take on that?
Yeah, I think that's just wrong. but it's taken in a different potentially context in a different era and time. So let me explain. When you're a KKR, a Carlyle, and you're raising $25 billion funds, and you've got lots of them, it's really hard to put that money to work. And if you think about buying a business, so a typical private equity firm, let's say they use 8 to 12% of their capital in a fund to buy a company. So let's just use 8%. 10% of a $25 billion fund would be 2.5 billion. So call it 2.2 billion ish, somewhere around there. That's kind of the size, bite that they want to take when they buy a company. Imagine how difficult it's going to be to quadruple that company in size in order to find a 4 times multiple of invested capital exit. Now compare and contrast that with the lower middle market. You buy a company that's got 15 million of EBITDA and you want to get to 50, or 55, 60. And how much easier is it? Well, I could probably do a half a dozen deals, to a dozen deals in a short period of time, and I can get to a 4 times multiple of invested capital, pretty quickly, and a high IRR. And what, if I'm in the kind of the upper echelon, which frankly, let's be honest, the people who are investors in those types of funds, you're talking about massive amounts of capital that needs to be invested. And typically they're not only investing up there, they're also investing in middle market backed funds as well. But for me personally, I just, as a CEO, find it so much easier in the lower middle market to kind of go from 15 million to EBITDA to 50, or 50 to 100, versus going from 250 to 500. The magnitude of growth is very different. And so what usually happens is, as you're climbing up the private equity pyramid, the returns and IRRs moderate.
Right.
And so people at the top of the pyramid are not modeling a 3 times to 4x multiple of invested capital. They're probably underwriting a 2 to 2.5, 3 if they're lucky, multiple of invested capital. And but because you're putting large amounts of capital to work, you're getting a lot of dollars back. But it's just a different school of investing. So there's not a right or wrong. Depends on how much capital you have, how much you're trying to put to work across how many investments. And certainly the folks at the top of the food chain have been doing this for a long time. These are great companies. But for me personally, I'm an investor in, call it, middle market PE firms, middle market PE funds, where return thresholds and profile happen a little bit quicker. It's a little bit easier. And I'm sure they would say that there's more potential for downside risk. But I also think that there's this is not VC. These are established companies. If you look at every company I ran, they were in business for 40 years before I got there. So from my perspective, also little downside risk. And really, it's all about, depending on the high multiple being paid today, because there's so much money chasing deals, not enough good companies to buy. My downside's protected, but where do I think I can get the appreciation that I'm looking for? So right kind of investor for every size type of fund. The larger funds probably have a lot more institutional investors, and guys like me, we like playing in the weeds. So we're at the bottom of the pyramid.
You have spoken about the industry fragmentation of the kind of the smaller companies that people might be buying. And I'm wondering if that fragmentation works in the favor of people that are trying to make acquisitions.
Absolutely. So pick an industry. Let's, as an example, I worked in the HVAC space for about 5 years, the last 5 years. So if you think about that space, I call it the phone book test. For those of us old enough to remember what a phone book looks like, and they had these things in the back called the yellow pages. If I could go to 40 different cities, take 40 different phone books and open it up to HVAC, as an example, or air conditioning, and I could find the names of different companies in each one of these 40 phone books, that's probably cluing me in that this is a highly fragmented industry. There's probably 5,000 or more individual companies playing in that market space. So I call it the phone book test. When there's a lot of companies in a space, even with a lot of PE activity in the industry, multiples tend to stay low, and multiple accretiveness, or the multiples go up as the companies get bigger, but there's not as much tailwind pressure from PE activity that's driving higher multiples. So, in HVAC, great example, I would buy companies, call it on average 5 times. And, I traded first time for 13 and a half times. And, if that company was trading again in today's market, it'd be 16 to 20 times. So if you think about how much accretiveness there is when you're buying smaller companies in a highly fragmented industry, the fragmentation keeps the multiples down at the lower end of the market. And as you buy 20, 30 and put them together, you're creating a much larger company. You're now higher up the PE pyramid. There's fewer buyers paying higher prices, and the multiples have gone up tremendously for the same size, for the same given company. And so you get a lot of benefit, and that's the arbitrage. You buy 20 companies, you buy them for an average of 5 times, and you put them all together, and then you've got something that's big enough for a bigger investor to come buy, and they're going to pay 15 times for it. So you get a lot of upside benefit as an investor when there's a buy and build going on in a highly fragmented industry.
Interesting. So 2 follow-up questions for that. The first one is that, can they smell you coming? I'm thinking, like, can these HVAC companies, right? Do they see that maybe you're in the market, and they're like, oh, these guys want to do acquisitions. Maybe we can like bump up the prices that way. I say this because when Walt Disney was building or buying the land that the Disneyland is built on, he'd have to go in secretly. He went in secretly, and he bought up all the plots of land, right? And because that way he could be a little bit more anonymous.
Yeah. So in HVAC, because of the nature of the way the industry contracts, I want the entrepreneurs to stay. I would want them to be rollover investors in the mothership. I can't be clandestine about it. I need to be very upfront about it. And matter of fact, I would sing it from the treetops. Hey, come join Cool Sis. We got 20 plus, entrepreneurs, who've joined the fun. And what, so I think very quickly an industry knows who's acquisitive regardless of industry and who's not. And of course, then the broker dealers, the small boutique investment bankers, the folks who are out hunting, looking for these smaller companies. Maybe they're a buy side advisor for a bigger company, and they're, go out and find me 150 targets that I can buy, and here's the criteria that I'm looking for, these verticals, these locations, this EBITDA margin profile. I call them filters. And I think the from a buyer's perspective, the biggest problem I see when private equity backed companies are doing buy and builds is they're not really disciplined buyers. They're chasing everything. Everything is a shiny penny. They don't differentiate between good companies, bad companies. So I like to think I'm a connoisseur of the buy and build. Been doing it a long time. And, my focus is very heavy up front on let's define what good looks like first. Let's only buy good companies. Let's not buy fixer-uppers. I don't have time for fixer-uppers in a 5-year PE hold period. And so I want to buy high quality, well-respected companies where the entrepreneurs fit from a cultural perspective, the bigger enterprise that we're building here. I joke and tell people, Ty Cobb, best baseball player ever, and his batting average was in the 400s. When you're doing M&A and you're doing buy and build, you damn well better be batting 900 plus, probably closer to 980. You can afford one bad one in about 20, but a bad acquisition takes so much energy from a management team. It takes so long to fix that it really can derail a buy and build. So people need to be disciplined up front, know what good looks like before they ever go out there and make contact with anyone.
So you were saying that multiples go up as companies get bigger. How and why does that happen?
So larger firms have larger amounts of funds. So we were talking about a KKR, a Carlyle, Apollo. You think about when you get to the top of the pyramid, if you've got a $25 billion fund, that you want to put to work, and 10% is your check size, and you want to write a check for 2.5 billion. How many companies are there on the planet that you can put that much money to work in? It's the bigger a company, the rarer the asset becomes. Here's a statistic for you that's kind of fun. On the entire planet, guess how many companies have $1 billion in revenue? This is the Jeopardy song now going. It's 3,000. There are only 3,000 companies on the planet that have $1 billion in revenue. So the bigger a company is, the rarer the asset, more opportunity for a larger PE fund to put more money to work. And so as a result of that, larger companies are worth more money. And when I'm a big fund, if all I did is buy small companies, it would take me forever. I wouldn't possibly be able to put all of my capital to work. And what's worse than not hitting your return thresholds for your limited partners? Not even investing their money at all. When they commit a certain amount of capital, they want you to put it to work and to get them the kind of returns that you're known for. And if you don't put the money to work, you have a real hard time raising your next fund, because people aren't going to commit the same size and amounts of capital to you because you're not putting the money to work. They're not earning anything on it, but they've had to hold it on the sidelines waiting for you to get it put to work. So big is rare, just like diamonds. Bigger diamonds are worth more than smaller diamonds because there's a lot more smaller diamonds. There are 31 million companies in the United States that have $1 million or less in revenue, and there's only 3,000 on the planet with $1 billion or more in revenue.
This is more of a day-to-day activities kind of thing. So in the Exit Strategy Playbook, you spend a lot of time instructing people on how to build their team. The banker, the attorney, the lawyer, all that kind of. How do you, you do 5 acquisitions at the same time. What does your team look like to do all those kinds of things? Because you're buying assets and selling assets on a very, very regular basis.
So normally, when I would go into a company, I'd probably go into a company that has no dedicated personnel doing M&A. If they're doing any M&A at all, it's a combination of people and it's a part-time job. And I immediately start building a team. So in 5 years, I'll wind up with 8 people potentially whose full-time job is doing M&A inside a corporate environment. So I typically look for, call it a VP of business development, or the leader of the effort would be hired first. And they'd have to roll up their shirt sleeves and get a little dirty in the beginning. But as I'm building the empire, then I'm adding analysts. I'm adding, I usually add investment professionals in teams of 2. Senior guy, junior person, senior person, junior person. And really that's, the junior person to do modeling, to do spreadsheets, et cetera. The senior person to build relationships and focus on deal structures, and be the strategy. I would then, so as you're adding deal people, eventually I add counsel, in-house. We're not writing contracts. We might be doing NDAs and letters of intent or indications of interest. But really what we're doing is we're building a team of professionals who can quarterback multiple deals at a time, often managing external resources or assets to actually do, call it the diligence work. So we would do the high value work. We would outsource and oversee the low value work and build a team of people. If you're going to do a buy and build in a fragmented industry, chances are you're going to be doing it for a very long time period. It's going to be longer than one hold period. And if it's going to be a long time and it's a highly fragmented industry, you want the company to develop muscle memory and get really good at knowing what good looks like and knowing how to get a deal through a pipeline and closed, so that you can be more self-reliant as you're climbing the PE pyramid and getting bigger. So I do spend a lot from a seller perspective talking about the professionals that they need to buy. So here's an insight or hire. Here's an insider tip. The biggest mistake I see entrepreneurs make, and I understand where it comes from, people who build a successful business are rare. Out of 100%, only 7% of companies that start ever see $1 million in revenue. Only 4% of those ever see $10 million in revenue. To build a good sized business is a rare event. Entrepreneurs who are successful tend to believe that success that they had in building a business translates and makes them an expert in selling the business. And really, they're a novice selling a business for the first time. And so what I try to do in the Exit Strategy Playbook is help them understand who the team of professionals are that they need to have on their side. Because I, as a buyer, when I'm doing a buy and build, boy, I can tell in 5 minutes if I've got a sophisticated seller or not. And although I'm a good guy and I don't take advantage of people, there are plenty of people out there who, if they sniff, that there's an unsophisticated seller, they're going to take advantage of that seller And it could even be just 4 or 5 word changes in an indemnification clause that really puts risk on the side of the seller and removes it from the side of the buyer. People will do that all day long. It's fair game. From my perspective, though, I was always a person who started with what was a fully negotiated deal, and I just wanted to get to reasonable and customary for a given size. I'll give them credit for having competent counsel, but boy, have I encountered sellers who just did not have competent resources around them, and therefore they were getting bad advice, making bad decisions, focused on the wrong areas of the transaction. So I do spend a lot of time talking about the professionals an entrepreneur or a business owner needs to have on their side to level the playing field against a very sophisticated buyer universe, to
Right.
make sure that they are getting reasonable and customary market, driven dynamics in a deal.
I got a question about strategic acquisitions. You had said earlier in a different interview that CoolSys, they serviced different industries. They serviced blood banks and pharma research labs. One interesting thing was a cell phone towers. How can business owners approach a strategic acquisition that goes in different ways?
So from my perspective, when I am a buy and build person leading a company that's going to buy companies, what I'm trying to do, first of all, it goes back to knowing what good looks like. That includes developing an acquisition strategy. So when I came into CoolSys, it was essentially 90% refrigeration and about 10% HVAC. And the refrigeration was predominantly in the grocery store space, and Walmart was the largest customer. And it was very competitive, I guess is the best way to say that. I was looking to make strategic pivots, finding blue ocean where I could potentially charge higher rates, be less driven by RFPs and RFQs. And so you talk about pharma and research facilities and laboratories and blood banks and cell phone towers. It's like mission critical to them is get here fast. If I go down, you be here in a few hours, get me back up and running. I'm a data center, and by God, I can't have servers shutting down. I don't care what I pay you to keep me up and running. Amazon is another great example. Amazon warehouses, for the longest time, and many still do, they actually had contractors had to immerse employees within the warehouse so that your instantaneous response was, immediate. I can think of different pharmaceutical type facilities, even take a drugstore. They may have millions of dollars of refrigerated drug inventory. And if that stuff is not refrigerated, for an X amount of time period, they have to throw all those drugs away. And so, when there is a mission critical need to keep something cold, oftentimes you can find, so first of all, it's the same skill set, whether I'm driving to a grocery store or driving to a blood bank or driving to a different facility, but based upon the need and the desire, you may have a more lucrative, higher margin profile industry that's adjacent to you. And so I'm always thinking about it in terms of when I'm doing a buy and build, my strategies usually include, I'm a regional company, want to be a national company. I'm a national company, I want to be an international company. I'm using acquisitions to open up new markets and get me into new geography. Sometimes I'm making strategic pivots, looking for adjacent markets where I can take my addressable market from 5 billion to 20 billion, and I have higher margin profiles on adjacent markets. And so I'm searching for blue ocean, higher margin business that's adjacent to what was the traditional marketplace. That could be another acquisition strategy, and then building density in existing markets. If I'm a service company, I don't want the people in the trucks driving any longer than they have to. If I had 8,000 locations in one city, I'm a lot more productive than 8,000 locations spread across 50 states. So you want to be doing whatever it is the business does. You want to spend all your time, if possible, doing that. So if you're a refrigeration technician, I would want that highly skilled, especially when tradespeople are in short supply. I want them spending all their time doing high value work, repairing systems, not doing paperwork, not chasing parts, not driving across a 4-hour, drive to get to the next location. So density is always important in a services business. These prime adjacencies are always important, building a larger addressable market and then entering into new geography. So I'm adding capability, strategic pivot, I'm going into new geography, or I'm building density in existing geography. Those are usually kind of the three strategies that I personally am pursuing because I typically am running service businesses.
How does the cell phone tower, what kind of cooling do they need?
Well, so think about, and I'm hypothetical. Pick Verizon, CenturyCellNet, CenturyLink. Just pick anybody you want.
Yeah.
Let's say they're out in Montana and they got a cell tower on top of a mountain, and that thing goes down. So you're thinking of an antenna that's at the top. Well, at the bottom, there's an equipment shack with computer racks and electronics. And if the air conditioning in that unit fails, the racks overheat. They're sized to be and engineered to be working, and so these are not giant rooms that if AC fails, they got time. Small confined spaces, equipment racks that generate a lot of heat. AC goes off, 20 minutes later, cell tower shuts down, goes offline because the equipment shuts off, and now I got a 20-mile gap in cell tower coverage because this is Montana, or I've got one critical mile in Manhattan that's not working, and so there's a different sense of urgency around, servicing that customer location. And really, when I'm building a service business, I want to find that customer that values the skill sets we have, and we're not commoditized, and we're not, just responding to RFPs, but we're providing a needed service, becoming a partner, a strategic partner. And, I can think of data centers, cell towers, hospitals, there's a number of places where, that might hold true.
That job to be done would be like, who needs it cold now?
And can't wait to save $5 an hour on labor. I can't wait to tomorrow. Tomorrow's too late. I need you there in 4 hours. Okay. But here's my rate to be there in 4 hours.
Yeah.
And hey, if I'm up on the top of a mountain, I might be in snowshoes climbing up there, and I got to dig out the door to get into the equipment room. And while I'm up there, do you want me to weed whack, in the summertime so that, the next time something breaks, somebody can get in here? It's like there's all kinds of needs that unique customers have. Hey, during COVID, we rebuilt the hospital ships, that needed their cold storage to handle, vaccine type temperatures. Ships are built around cold storage. They're never contemplating taking a ship apart and getting something out of the middle of it and replacing it. So you're doing it panel by panel and, piece by piece, but, that's a mission critical need, so, it's just an example.
Yeah. Really interesting. I was reading in the book that you said, choosing the time to close is an important thing, and specifically don't close during the holidays. Well,
so it's funny. Yeah. So I did mention that in the book. I said, first of all, when you're a seller, be a seller. When you're a prepared seller, be a seller. Doesn't matter what time of year it is. But if you're just thinking out loud and saying, geez, when would I want to plan an exit? Typically the month of August, the A team is on vacation and the B team is minding the store on Wall Street, and then in the holidays, people can be a lot less aggressive. They've had a good year already. They've earned their bonus and it's time for the holidays, and their head's not tuned in to the marketplace. But you get to the, early January, it's like, okay, the new year has begun. I'm back to zero. I got to get deals sold, financed. I got to hit my numbers for the year. It's like all of a sudden there's a lot more interest and activity, both in the debt lending markets and in the universe of buyers. And you could say, hey, somebody will buy a good asset any time of year. Of course, of course they will. I'm just saying that people tend to be more aggressive certain times of the year than they are in others. And sometimes people are distracted because of holidays or, vacation, standard vacation time in August, when Wall Street shuts down and everybody goes on vacation. Mm-hmm. So I always try to think about, if I'm going to be selling a business, when do I want to be in the market? That's a part of my calculus.
As a capital markets aside, when I read that, I nodded my head agreeing. typically, not always, but typically you have really tough equity markets in August. And the journalists in the room will attach that to some event that's going on. They are right now, right? Oh, it was because of some speech that was done or some war that broke out. No. It's all about liquidity. And when all those Wall Street bankers and portfolio managers go on vacation, there's no one to buy when you want to sell. So
Yeah.
it's the same in the equities market, Adam. It was a great analogy.
Yeah, good.
So if I am a small business owner, right? I've built a business, it's cash flowing very well. What are the questions I need to ask myself in order to move down that path towards a sale or a first bite of the apple versus the second bite of the apple?
So from my perspective, an entrepreneur has to have a good understanding of their financial picture, and so companies are typically bought and sold as a multiple of EBITDA. Do they know what EBITDA is? Do they know what their EBITDA is? And do they have 3 years worth of financial records in place that are clean, that paint the picture that the buyer universe is going to want to see? So I think a seller needs to be prepared first by knowing what is it I'm selling and what's its value, and doing things like getting their financials cleaned up. Small business, hey, I've been writing off the lake house. Uncle Jimmy died 20 years ago, but he's still on payroll. I got, I got to clean up my numbers. I got to get my adjusted, numbers, kind of blessed. I need some accountants to help me, need to do some tax planning in advance of all this. Want to probably do a sell side Q of E, or at least understand what the true earnings of the business are, so that we understand what we're selling. And then I'm probably going to want to talk to people and try to find out what businesses like mine in a given industry are trading for, and understanding kind of what the differentiators are, between a good price and a bad price. And then also understand, as my company were to get bigger, when's the right time to sell? So I talked about swimming lanes earlier. You've got a universe of buyers who are out there playing in the 0 to 15 million EBITDA size. They're smaller businesses. And then they typically take an asset up to an inflection point. Someone who buys at 15 goes to 50, then they sell it to somebody who's going to take it to 100. And if you're close to the edge of a swim lane, usually the multiples get higher, as you get closer to that end of the swim lane. So if I'm, in today's world, because there's so much capital chasing so few companies, people that used to buy at 15 today are reaching down and buying at 10. So if I'm sitting at 6 million, 7 million of EBITDA as an example, and I'm thinking to myself, okay, the multiple I get today is going to be a lot less than if I just stay the course for another 18 months and I get to 10. Because I'm reaching that new swim lane where bigger guys are reaching down and they're going to pay a higher multiple. Again, the rareness is the asset gets bigger, not enough good stuff to buy. So it's kind of like I always want to have a plan. What's the industry trade for? How do I get to the highest side of the range for that? Am I near a swim lane inflection point? Do I have competent people advising me? Do I understand what my numbers are? And do I understand what my earnings really are? And so that I can understand what the value of this business is going to be before I ever even go out and test the market. I think spending more time on the front end yields a better outcome.
Dad, do you have any more questions? And then I'm going to go into the final four because we are approaching top of the hour.
Go into the final four.
Final four. Okay. So the first one is, this is not about private equity. It's not about acquisitions. We're curious about you in general, right? Do you have as you've learned about things in business, are there any information things that you've really enjoyed? Maybe your top 3 favorite nonfiction books or documentaries you've seen. What has influenced you in business the most?
So experience brings a lot of life lessons, call it. I think when I was a young person, this is a 20-plus-year-old book, but I think it's still as relevant today, is The Millionaire Next Door. If you're starting a business, if you're seeking to generate wealth, you need to understand what wealth really looks like. And it's not always as flashy as you think. And And so, I think in my early man young days, I was reading books like The Millionaire Next Door, The Millionaire Mind. I was reading some business books, Jim Collins and The Flywheel. And, I mean, there's a lot of lessons to be learned from a lot of different people in life. I think the biggest life lesson I've learned, as I've gotten older is patience is one. Be open and willing to accept help, recognize you're not an expert at all things, seek knowledge from others who are experts, and learn from them. And then I think the most important thing I've really learned is that you can treat people well and generate profit. These are not mutually exclusive concepts. In today's world, with today's workforce, you need to build a good, strong employee culture if you want to be successful in the world, and in the business world. So from my perspective, I don't manage revenue, I manage culture. I get an engaged workforce. They take care of customers. Customers give us more stuff. Revenue takes care of itself. So it's all about employee engagement. For me, that means be a transparent CEO, transparent leader. Certainly there's been books, and learnings, along the way. I would say never stop learning. I had been teaching at a major university for a number of years, and I then went to its business school. It's like, because I was 50 years old, when I went to the business school. It's like, I went and got my corporate governance, credentials, at UCLA as however old I was at the time, 54, 55. It's like, never stop learning. Always seek out opportunities to continue your education. You've never arrived, and you're never going to stop learning. So embrace learning, seek out opportunities to learn, whether it's academic, environment and it's school, or it's books and you're reading, or it's just networking. I think you learn as much from, call it peer groups, and, not to plug YPO or Vista or anybody like that, but it's like, you need to surround yourself with other people like you. You're in business, they're in business. What mistakes have they made that you can learn from, and vice versa? And it's about best practice sharing and being open to learn and take advice from others.
Tools. This question is about tools. What tools do you love? Not like a hammer or a saw. Are there any specific apps you're using, or things you use on a daily basis that get you through your job that you really appreciate?
Well, today I am a consultant, right? So I hung up the CEO cleats last year, and I am serving on boards. I'm working with private equity firms. I'm working with portfolio company CEOs and leadership teams. I'm working with founders. And so for me, my life's blood is LinkedIn. It is America's billboard. It is the party line, of telephones of the 1970s. I mean, it's, all people need to have a strong presence where other people are located. So I think from an industry perspective, it's trade shows, it's being plugged into the local business community, and usually that's through what I'm going to call the publication, the business journals. They're in every city. Orange County Business Journal, the Dallas Business Journal. It's like there's one in every market. They hold events where they bring business leaders together. Tapping into that market, I think is an important tool. Having presence, if you want to talk app, for me as a consultant on LinkedIn is a tool. I also belong to the Forbes Business Council and write articles every month. In that capacity, and I love the opportunities that have come to me through through places like that. So it's not so much app based, sure, as it is just plugging into the local business community through the journals, being active on the places where other business people are, both clients, potential clients, and or even competitors, just to stay tuned and be a part of an industry.
Resources, tools, that totally makes it. What's your favorite thing to do outside of work?
Chasing those $150 hamburgers, I think, that we talked about. So I tell people that a male adult could be guilty of as many as 4 sins. And I'm talking about things now. So there's car guys, there's boat guys, there's RV guys, and there are airplane guys. So I'm an airplane and a car guy. You don't want to have all four sins at once, because if you do, you're really, really in trouble. And so, although I love big boats and I love RVs, it's like I've abstained from those because I'm all about cars and airplanes. So
better view on the airplane.
For me, it's about aviation experiences. So that picture up above my mantle there is me flying a World War II P-51 Mustang, and I'm holding a GoPro in one hand, and I'm doing a barrel roll over Orange County, California, in that picture. So for me, it's, hey, how many people can say they've flown a World War II P-51 Mustang and done aerobatics in it, and I'm looking for experiences.
That's so cool. Did you see the Top Gun movie? I haven't seen it yet.
It's great. It's great. Yeah, I thought it was
cool to do.
A lot of people don't know this, but that is actually Tom Cruise's P-51 Mustang. He keeps it in Santa Monica, and it's like that's his actual airplane.
I wonder if he would rent that out, or if you can rent like a fighter jet. Oh my gosh!
If you're rated, you can get access to anything with money.
There you go. That's a good kind of almost last phrase. Where can people find you?
I am on LinkedIn. Type in Adam Coffey. You can go to my website, adamecoffey.com. Coffee, Coffey. And I respond. It's like I wrote my first book. People were reaching out from all around the globe. I encouraged them in the book to do it, and their questions led me to write the second book, and the questions from the second book, are leading to a third book. It's like, I love engaging with the people out there. It makes the world smaller, and it's been a lot of fun. I've had people send me pictures of my book in very strange places, and it was, like in front of the Taj Mahal, and I'm not talking about weird things, guys.
Okay.
But like, hey, the pyramids in the background, and there's my book, or whatever. It's like, so I've had some fun experiences. And I think the best moment is if you walk on an airplane and you see someone reading your book.
Yeah.
And you sit down. What did you think? Is it any good?
We would love to have you on. When's the third book coming out?
So the outline is done. I'll start filling in the out. It's going to be over the winter. I'll get the manuscript done. So you're probably looking at Q3 next year, about a year from now. It takes about a year.
Well, Adam Coffey, thank you so much for coming on today. We look forward to having you when the next book comes out on the Just Build Wealth podcast. Ed, final words?
If there was ever an example of the term just build wealth, we just talked to him for the last hour. So I think it was a great symbolic speaker to talk to.
Well, Mike Ryan, thank you for having me on. Listeners, thanks for tuning in.
Thank you very much.
See you later, guys. Thanks for listening to Just Build Wealth. You can find the show notes for ideas referenced in this podcast and pick up a copy of The False Hope of Global Diversification at www.falsehopeglobaldiversification.com.
This podcast is free to listen to, but if you share, we can create more content and continue having excellent conversations. So, as my favorite podcast host, Jordan Harbinger, says, we rise by lifting others. Rate this in Spotify, Apple Podcasts, or wherever you get your podcasts. Share and give us feedback because we want to continue making great content. Thanks so much.